Welcome back. Today we are diving headfirst into a really fascinating financial mystery surrounding an absolute titan of Wall Street, JPMorgan Chase Co. We're going to systematically piece together some recent market data, dive into their earnings, and look at analyst ratings to figure out exactly what is going on beneath the surface of this stock.
Okay, let's dive into this. Our story really kicks off with a major move in the fourth quarter. Heavyweight hedge fund Jennison Associates suddenly unloaded nearly 74,000 shares of JPMorgan Chase. That cut their total stake by about 5%. Now, when a major institutional player trims a massive blue-chip position like that, your immediate instinct is probably to ask, wait, is there a crack in the foundation? Do they know something we don't?
Now, what's really interesting about this is you'd totally expect they sold because the bank was struggling, right? Well, actually, no. JP Morgan absolutely crushed their fourth quarter estimates. Earnings per share hit $5.94, completely blowing past the Wall Street consensus of $5.50. They brought in over $50.5 billion in revenue for the quarter, easily beating expectations, and that represents a rock-solid 10% year-over-year growth. Add in a net margin pushing 21% and a return on equity over 17%. It's pretty clear the bank is a powerhouse operating at absolute peak efficiency.
Which brings us to the core of our puzzle today. Why dump a winning stock? Honestly, on the surface, it defies basic logic. If a company is outperforming expectations, generating massive revenue, and growing year over year, why would a sophisticated smart money hedge fund choose that exact moment to sell off tens of thousands of shares? Are they seeing storm clouds on the horizon, or is this just a totally different strategy playing out behind the scenes?
Let's start breaking this down. Section 1, digging deeper into stakes and dividends.
So headlines about a hedge fund cutting its stake can definitely spark some panic. But here is the reality check. Jennison still holds 1.4 million shares. And those shares? They're valued at a cool $452.1 million. So this definitely wasn't them abandoning ship. It looks a lot more like they simply took some chips off the table to lock in profits after a really strong run, while still keeping a massive core position in the game.
Plus, let's not forget the payouts. JP Morgan just paid a $1.50 quarterly dividend, which translates to a $6 annualized payout per share. That offers investors a solid 2.0% yield. And because they have a highly conservative payout ratio of under 29%, that dividend is incredibly safe. It makes the stock a really attractive setup for anyone looking for reliable income.
Let's move to part 2 and see how this builds. The counter moves, how other funds reacted.
So while Jennison was trimming their position, a whole lot of other institutional heavyweights were actually on a buying spree. Brighton Jones bumped their holdings up by 11%. Acorns Advisors and Ignite Planners added to their stacks. Jump Financial initiated a brand new $1.47 million position out of thin air. And Betterment, they boosted their holdings by a massive 27.5%. At the end of the day, hedge funds and institutions still own a dominating 71.55% of JP Morgan stock. That signals a profound, broad confidence across the board.
Moving right along to Section 3, insider trading and headline news. We also have to look at what the people inside the house are doing. CFO Jeremy Barnum recently sold just over $935,000 worth of his stock, and another insider, Robin Leopold, sold about $127,000. Now, that might sound like a red flag, but wait. Context is everything here. Barnum still retains over $10 million in stock, and his trade was actually executed under a prearranged Rule 10b5-1 trading plan, meaning it was scheduled way in advance. Overall, insiders still retain a healthy 0.41% ownership of this $800 billion behemoth.
And outside the bank, well, they are navigating a seriously complex news cycle. It's a real mixed bag. On the innovation side, they've got this massive positive catalyst, partnering with Ripple, MasterCard, and Ondo to handle near real-time, cross-border tokenized U.S. Treasury redemptions using the blockchain. Huge deal, right? But on the flip side, they're facing regulatory friction. There's an ongoing lawsuit alongside Citigroup regarding frozen payments tied to a sanctioned Chinese firm. It is the classic tug-of-war between cutting-edge technological advancement and real-world global legal hurdles.
And the macro picture is honestly just as split. On one hand, you have rigorous financial analysis from institutions like Erste Group confidently raising their fiscal year 2027 earnings estimates for JP Morgan. They see nothing but strong, continued profit ahead. But then, you have JP Morgan's own CEO, Jamie Dimon, issuing some pretty stark warnings about a potential bond market crisis. So we're left with this fascinating dynamic where the bank's underlying operational strength is incredibly robust, even as its top executive points to storm clouds gathering in the broader economy.
Which brings us to our final piece of the puzzle. Section 4, Wall Street's final verdict. If you're feeling a bit torn on what to make of all this, you are in very good company.
The sheer complexity of this stock is perfectly mirrored by the Wall Street consensus. Out of 30 major analysts tracked by MarketBeat, we have a literal down-the-middle 50-50 division. Exactly 15 buys and exactly 15 holds. We've seen totally opposing moves recently too. Piper Sandler upgraded their outlook to overweight, while Autonomous Research went the other direction and downgraded to neutral. The street is completely divided on what comes next.
So, the crucial point is, where do they ultimately think the price is going? Despite the division, the average consensus price target sits at $338.12. Given that the stock recently opened around $301, that actually implies a really healthy upside, netting the stock an overall consensus rating of moderate buy. Analysts definitely see the macro risks and they see the profit taking, but they simply cannot ignore the sheer earning power this bank continues to crank out.
Which brings our narrative full circle. Back to the question I want to leave you with today. When we see a headline about a major fund like Jennison cutting its stake by 5%, does that institutional profit-taking mean a company is fundamentally broken? Or, as we've seen through the incredible earnings, the steady dividends, and the buying sprees of competing funds, is it just a smart money expertly managing their risk? I hope this explainer gave you a clearer, more structured way to interpret these complex market signals. Thank you so much for joining me to solve this puzzle today, and as always, keep asking the right questions.